Everyone's talking about a potential 2021 housing crash. In fact, the media is having a frenzy, leading us all to believe that we're headed towards another housing crisis, another housing crash like we saw in 2008. There's a lot to talk about here. If we haven't met, my name is Mulrenin. I'm a real estate broker. I also own a mortgage company and a title company. Been in the business for 16 years. And in this video, I'm going to share with you all of my insights and give you the truth. I'm going to break through all the rhetoric. I'm going to break through all the noise. And I'm going to share with you, what do the facts say? What do we really need to know about a potential housing crash in 2021 so that you can make the best decisions? Do you need to be scared? Do you not? This video, you're going to learn it all. First off, let's look at the three things that cause a housing market crash in the first place. And let's look at what happened in 2008. The three things that cause housing markets to crash are bad mortgage loans, which then lead to foreclosures, which then lead to increased inventory levels, which ultimately cause housing prices to crash. This is exactly what happened in 2008. Let's look at the type of mortgages people were getting in 2008. The mortgages, and it wasn't all because of these loans, but a massive issue with the mortgage loans at the time were loans called negative amortization loans. And here's how they worked. A homeowner would get a mortgage and their monthly payment wouldn't even cover, now listen closely, wouldn't even cover the interest on the mortgage. And you would only have to qualify to get that mortgage based on this type of payment. So as an example, somebody might get a $400,000 mortgage, and back in 2008, interest rates were at 6%. So if we look at just the interest-only payment, it would come out to be $2,000 per month. Well, on these negative amortization loans, they were typically about half of the interest-only payment, meaning that the person qualifying for this mortgage, the person getting a $400,000 mortgage, only had a monthly payment of $1,000. And the other $2,000 of interest was accruing to the back side of the mortgage. So every time this person made a payment of $1,000, they weren't even covering the total interest on the mortgage, so $1,000 every month added to their mortgage balance. And this was the problem with the loan. What would happen is, over a certain amount of time, because you weren't allowed to do this forever, you were allowed to do this for just a certain amount of time until the loan did something which is called recast. At that moment in time, the mortgage then would re-amortize to a 30-year principal and interest mortgage. And in this case, on a $400,000 loan, the mortgage payment would be almost $2,500. Now keep in mind, the mortgage company qualified the person on only a $1,000 mortgage. And so the person getting a $400,000 home was only making $30,000 to $40,000 a year. When their mortgage payment went to $2,500, obviously they couldn't afford it. They were forced to walk away from the property. In addition to these negative amortizing loans, we also saw loans we called NINAs, no income, no asset verification mortgages. What did this mean? So not only were people getting the negative amortization loans, they didn't even have to show proof of income, proof of assets. And mortgage companies backed by Fannie Mae and Freddie Mac were allowed to lend money to people where they didn't have to show any proof that they were actually getting an income. No proof at all that they had any assets in the case of a rainy day. They were able to get mortgages, $400,000, $500,000, $600,000 houses, proving nothing and qualifying on a mortgage payment that was less than the interest on the home. These were the types of mortgages being given to millions of people in the United States during the 2008 housing crash. This obviously led to massive foreclosures, which then increased inventory levels, because we're going to talk a lot about in today's video about supply and demand and how that affects a housing market crash or not. So once millions of people started foreclosing on their property, new homes started flooding the market. And in fact, if you look at how many homes were actually for sale in any given month in 2008, 2009, 2010, what you're going to find is there is over 3 million homes at any given time for sale on the market. We're going to look at how that compares to the market here in 2021, and you're going to draw a massive conclusion. Now, once all these foreclosures flooded the market, inventory levels were at all-time high. We had over 3 million homes for sale. What do you think that did to the actual prices or values of home? Well, this is a simple supply and demand issue. As supply goes up, as demand goes down, prices plummeted. In fact, if you look at my computer right now, you're going to see that at the end of the economic collapse, right here in 2012, the US average home price was all the way down to $162,000, hitting almost record lows for home values United States has ever seen. So, where are we at today in comparison? Let's look at mortgage loans today in 2021 as they compared to the mortgage loans we just discussed in 2008. Qualifications have never been more difficult. If you're buying a house or you've been through the home refinancing process in the last year or two, you know it's so difficult to get a mortgage. Why? Mortgage guidelines are so tight. They're so rigid. You need to document and prove everything. They need all kinds of documentation before they start giving you a mortgage. So tighter guidelines means more qualified borrowers. And there are no subprime mortgages right now. You either qualify under these tight guidelines or you're not getting a mortgage. So what does this mean? This means that people are more highly qualified to borrow money than ever before, which is the reason why we've seen foreclosure rates continue to go down, not up. In addition, we need to look at mortgage interest rates. So when you look at mortgage interest rates, the Federal Reserve bases their decision, increasing interest rates or decreasing interest rates, based on how the economy is doing. Now, as we're coming out of this pandemic, there's many believe that the US economy is going to recover and things are going to start to get better. Well, when the economy starts to do better, the Federal Reserve they tend to raise mortgage interest rates. Interest rates in the mortgage world work like a teeter-totter. If the economy or the economists believe that the economy is headed for some trouble, the Federal Reserve will then lower mortgage interest rates to compensate, and the exact opposite. So as you see interest rates in 2021 start to tick up a bit, that's a sign that the US Treasury and the Federal Reserve believe that the economy is heading the right direction. Let this be concrete evidence that the economy is in the right place and we're not heading down like the media wants us to believe. A big talk is mortgage delinquencies. So the media is suggesting that mortgage delinquencies are going to lead to foreclosures, which is why so many people believe there's going to be a 2021 housing crash. Well, what we have to take into consideration, if you look at my screen now, you're going to see a report from the Black Knight company, who is a data analytics company. And they put out a report every single month, and this is a report at the end of January 2021 going into February. And you can see that mortgage delinquencies are trending downward after the pandemic hit, which suggests that people are no longer late on their mortgage like they were. Furthermore, you have to look at how many of these delinquencies are due to forbearance. You see, what happened is due to the pandemic, there was some mortgage relief plans. There were forbearance options for people to take advantage of while maybe they were out of work. And so what we need to look at, if you look at my screen, is you're going to see that of the there was about 6.9 million people that took advantage of the COVID-19 related forbearances. You can see that. Okay, great. This is what the media is having a frenzy over, because they say, okay, 6.9 million people are late on their mortgage. What does that mean? Does that mean that's going to lead to foreclosures? Well, if we look at the report and we look a little deeper, 3.7 million, or 54% of the people that were in forbearance or delinquent on their mortgage are either back to performing or have paid off their mortgage in full through a refinance. So the thing that a lot of people were kind of hanging their hat on, talking about this 2021 housing crash, they believe that because so many people were late on their mortgage, that ultimately those were going to all lead to foreclosures and flooding the market with inventory. Well, based on the data, over half of those people that were in a forbearance program are now out of that program and back on a traditional mortgage. Now, this is a big one. The major factor that determines home prices and if there's going to be a housing crash or not is simply a question of inventory and or supply and demand. So if you look at my screen, you're going to see that at the end of 2021, we had just over 1 million homes for sale. Now, let me put that in perspective. Remember when I said how many homes were for sale in 2008 when we had a huge housing crash? They were over 3 million homes for sale. Now, when you go month to month, we only have just about 1 million homes for sale. And so if you look at the inventory report, you can see that at the end of January 2021 right here, we had less than 2 months of homes for sale, meaning that if not another home hit the market in less than 2 months, there would be no houses for sale. Well, this is the thing that's driving home prices up. If you continue to look at this report by Realtor.com, you'll see that home prices at the same time are almost at all-time highs. So you've got supply that is almost next to nothing. You have home prices that are going up. Why? Because you have the demand that's at an all-time high as well. With interest rates being so low, and you have sales that are rising. Look at the sales in the end of January 2021 in comparison into the past. So this is the perfect storm. You have low inventory. There's nothing to choose from. You have super high demand, lots of people looking to buy homes, nothing to choose from, driving home prices through the roof. And so in order for a housing crash to occur or for it to happen, remember the 3 things. There has to be bad mortgage loans, which there are not. Those have to lead to foreclosures, which we just talked about, mortgage forbearance and delinquencies getting better, not worse. And then inventory levels have to be increasing. All of those things are the opposite right now. In addition to that, we have to look at home equity positions. People right now in 2021 have so much more equity in their properties than we saw homeowners have in 2008, making it that much harder for people to walk away from their property. Because here's the reality. Let's just say people are out of work due to the pandemic. And by the way, unemployment rates are also going down as more and more people go back to work. But let's just say they are in trouble and you do have equity in a home. Well, isn't it reasonable to believe that instead of walking away from the home like you did in 2008 because your house was worth less than you paid and worth less than you owed, that was an easy decision to walk away. Now, if you have maybe 50 or 40% equity in the property, instead of walking away from all that money, maybe you pull an equity loan out to help make your mortgage payments until you get back on your feet, till you get back to work. And so this is another reason why more and more people, it's going to be harder for them to walk away from their properties like they did in 2008. So to sum all this up, we have mortgage guidelines that are tighter than ever before. You've got more and more people that are getting up to speed with their mortgage payments. We're seeing delinquencies go down. We're seeing forbearances go down. We're seeing less and less people even think about foreclosure because of their equity positions and different opportunities that they have right now. And you see inventory levels continue to go down, driving prices up. Ladies and gentlemen, there is no facts, no evidence whatsoever that I've seen, and believe me, I've been scouring every report everywhere on the internet looking for some evidence that suggests a housing crash is going to happen in 2021, and I just don't see it. All of the facts right now point to the market continuing to strengthen. And so what are your thoughts? In the comments section beneath this video, let's have a dialogue. I'm gonna hang out there for the next hour or two after I upload this to YouTube, and let's have a conversation. What are you seeing? What am I missing? What are your thoughts? What are your beliefs? Do you believe the housing market in 2021 is going to crash?